It's my pleasure today to have conversations with Richard Sandor and Neil Wallace about some of the topics we've been covering the last day and a half, and that we'll be continuing on this afternoon. Richard Sandor is the chairman and CEO of American Financial Exchange, and this is an electronic exchange for direct interbank financial institutions and to support lending and borrowing. Even more importantly, I think he's the Ronald Coase Lecturer in Aaron Director Lecturer at the University of Chicago. So he's got firm Chicago connections and ties here. I was going to talk a little bit about this recent book that Richard wrote, but actually the current CFTC chairman has wrote something that I thought was much more important than what I could say, or at least more articulate in some respects. In a recent speech, he made reference to a white paper written in 1970 by a young graduate student in economics at Berkeley. I'm not quite sure. I thought that
I was teaching there.
Okay. I thought it was a graduate student of Minnesota, but we won't quibble with that. He said the white paper is entitled "The Preliminary Design for an Electronic Market," and this is. And then he wrote, what I found fascinating about Dr. Sandor's recounting of his 5-decade-long evolution from the pits to electronic trading was the absence of any grand plan behind the transformation. Instead, it was a series of incremental commercial developments. At all times, the impetus was the demands of market participants and the response of market operators to reduce trading costs. At no time did government step in and say, henceforth, all futures tradings shall be done on electronic changes. And indeed, Richard was really central in the creation of interest rate derivatives on the Chicago Board of Trade. I also have Neil Wallace. Neil was on my dissertation committee many decades ago. I'm probably not his most prized student, but I certainly was proud to have him on my committee. I find Neil fascinating for a couple reasons. So one, he was the University of Chicago PhD, no doubt being heavily exposed to Milton Friedman. And there was monetarism going on here, and in kind of a very big way. And when I first came out of graduate school, I remember going to many Carnegie Rochester conferences, and there'd be these like sessions on estimating demand for money. And there would be these empirical estimates and these debates over exactly what measure of money do you put in this equation to make money look stable. And there would be this be like an empirical exercise to try to figure out all this, and there'd be multiple changes in the definition of money to kind of make this relationship work and everything. So it's kind of interesting to see Neil come out of this kind of Milton Friedman monetarism environment to say, basically challenge the economics profession to say, well, maybe we need to think a little bit more carefully about money. Maybe we just don't posit a demand for money function, and maybe we need to really kind of open up the hood and understand what's going on in order to really have a good understanding and about how money works, and even thinking about its implications for policy. So indeed, I think Neil has been one of the a very big influence on the economics profession, to kind of making us think about money from a much more primitive starting point. And so I've always been curious what influence Milton Friedman had on this thinking. So it'd be interesting to go back and see Neil in one of Milton Friedman's classes, just to see what reactions were happening then. Anyway, my plan is as follows. I've crafted a few questions. Some's directed to each of them, some directed to both of them. And which I'll be looking for responses for. I want to reserve some time at the end for open things up for the audience as well. As you can see, that we have two rather coming at these issues of cryptocurrency, blockchain technologies, and the like from rather different perspectives or different vantage points. So let me start off with a question for Richard. So we kind of heard yesterday from Don Wilson about the potential values of things like blockchain. Rob Townsend last night was in his after dinner talking was suggesting ways we could use economic tools to actually think about some of the different type of potential uses of distributed these distributed ledgers and the like. So Bitcoin has received a lot of attention. The underlying Bitcoin and other crypto technologies, or the so-called blockchain technology. So what do you see as the value of these technologies in the future for reducing transaction cost and for facilitating economic activity?
Thank you. If anybody's wondering about the crazy shirt, my wife is an artist and it's a Basquiat painting, and I thought it would be a good metaphor for this conference. Sure. It was considered radical at the time, he along with Andy Warhol, and now it's become blue chip art that trades for tens of millions of dollars. So how long did that take before invention ultimately to mass adoption, which is kind of, and I want to frame the answer to the question, which somewhat the book does, but in a difficulty and in a Schumpeterian sort of way. Schumpeter speaks of invention, the act of creating, innovation, the act of commercialization, and then replication. And I think the blockchain is further along. If we look at the history, I think most people think it began with Nakamoto in 2009, but it really didn't. It began in a journal of cryptography by Haber and Stornetta, and it's about time stamping. And there was no web at the time, so what they did for third-party validation, published an ad every week in the Sunday New York Times, and that ad still exists. So that's the verification. They went on to commercialize it in '94. Then came the cryptocurrencies in '09, and so if we mark it, it's a 31-year period, which says that the blockchain should be ubiquitous by 21 or 22 if it follows the same path that electronic trading. So it's not a thing of tomorrow, it's a thing of today. And the distributed ledger technology, I think, is going to facilitate an enormous change in the way, and perhaps as much as the web did. It really is a way, as you know what it is, but it really is a way of treating identity, value, and ownership. Mm-hmm. And in ways that, especially in the context of the University of Chicago, which I love and is dear to me, it's about property rights, transaction costs, and markets. And it hits on all three of those for facilitating transactions. And the identity could be gold, it could be a bond, it could be a stock, the value can be recorded, and the ownership can be recorded. And what's going on in this space, and that's already here, it's not even tomorrow. You've got companies like JP Morgan that are internally using the blockchain for payment speed and for compliance and regulatory purposes. You've got Citibank that's created an ADR type of structure. You have Bank of America, which has 50 patents. Goldman has just raised money for a payment system for small businesses. And we don't realize how ubiquitous it is. And you can actually go and look at Steam, which is a new kind of coin, but the underlying structure is social media. And the hypothesis is this could and maybe should displace Facebook, because by giving property rights to the user then can sell its own data. This is my income, this is where I live, instead of it being put in the hands of another company. So we're already seeing the property rights aspect of it being implemented with the social media platform. And that's just the beginning. And the last one, just to give you an idea, and I do mark it as an important, Shenzhen in China has just adopted a blockchain, and it's using it for verification of agricultural loans. And when you get the Silicon Valley and this important province using the blockchain and implementing it for payments and verification, I think that says a lot about the future. I could go on with examples, but time is limited.
Okay. Yeah, thank you. This idea about being able to kind of control and market your own information is kind of fascinating to me, because one thing I worry about a lot of the internet technologies that we have now is that privacy is kind of a non-trivial issue, in the sense of, we reveal lots of stuff through our transactions, and the more that can become publicly available, we should be exposed.
Yeah, but if we can control who gets them, and we own the property rights, it changes the dynamic of it. And if it is in a blockchain, at least not the input or the output, but the actual stuff in between, the guts, is not hackable. And so it becomes a way to deal with privacy issues and property rights.
Did you want to say any more about blockchain, or you don't have to? No. Yeah. Okay. So the next question is for Neil. So how should we view Bitcoin relative to more familiar ways of overcoming double coincidence difficulties?
So first of all, I'm delighted to be at this conference. I've learned a lot. We've heard sort of two kinds of papers at this conference. We've heard papers that fall within monetary theory and sort of abstract from the details of cryptocurrencies and sort of treat them as some kind of money. I'm going to sort of go on and answer Lars's question and sort of talk about what kind of money we might view cryptocurrency as. And then we've had a lot of papers on the details and possible problems with cryptocurrencies, and I'm not in a position to comment on that. I have found the discussion very interesting. So to try to sort of fit Bitcoin within the class of things that we've loosely called money, and Lars made an interesting introduction. I mean, I view all three of us as students at Minnesota because I came there straight from the University of Chicago in 1963, and it's fair to say I knew nothing. And so to the extent that I've learned a little economics, a lot of it was during my 30 years at the University of Minnesota. So anyway, so let's move on. So a long-standing question in economics is what kind of setting gives a role for money? Now, the traditional answer to that question is some kind of double coincidence problems. And the first statement of that goes back to some Roman jurist in the 3rd or 4th century who said something like, I don't have the quotation in front of me, it was written in Latin and I've had it translated, but anyway, he sort of says two people meet and one has what the other one wants, but not vice versa, so some common medium of exchange was created. And that story, I mean, you've heard it all. It gets repeated down through the ages. It appears in current money and banking textbooks. But the story is hugely incomplete. Who are these two people? Are they me and my wife? Probably not. Are there two students who are sitting next to each other in a class throughout the semester and are good friends? Probably not. Implicit in that story is that those two people are strangers. Now, what does it mean that they're strangers? Well, I think it means the following. I think it means that that the histories of these people are not common knowledge. Or in the language of game theory, that there's imperfect monitoring. Now, why now, that's an idea that's come into common acceptance, among economists slowly. I credit Joe Ostroy for having that idea in his PhD dissertation, published in 1973. Rob Townsend made a contribution, Narayana made a contribution. Coming out of that literature comes a proposition. Goes something like, imperfect monitoring is necessary for money to have a role. Or in Frank Hahn's terminology, for money to be essential. Now, so I've used the word money, and I've used the word essentiality or playing a role. So what do those things mean? In the context in which you want to prove this proposition, the money is a currency-like object. And we're going to come back and say that it could be a cryptocurrency. And what does it mean for money to be essential, to play a role? It means that better allocations can be achieved in the presence of this stuff than in its absence. Now, this emphasis on histories, it does a huge amount of things. First of all, it integrates monetary theory with the rest of economics, but not with the Arrow-DeBrugh model, because the Arrow-DeBrugh model has commitment in it, and no one does game theory assuming that agents can commit. No one can commit to anything. So it accomplishes that, but it also has an application that I think is sort of relevant for this question about how do we judge cryptocurrencies. It should point us to thinking about different payment instruments in terms of the informational network that supports them. Lars mentioned Milton Friedman sort of advocated using M1, using M2, whatever. In Europe, checking accounts were very different instruments than they are currently in the United States. They weren't widespread. If you had a checking account, you had overdraft privileges, and I think the banks guaranteed your payments. So the checking account was a lot like a credit card in terms of a payment instrument. And credit cards depend, of course, on an informational network. It's no accident that they become widespread along with technological improvements that have allowed for record keeping. So now let's think a little bit about where cryptocurrencies and these other forms of payments kind of fit in. Now economists have been thinking for a while, and certainly a lot recently, about cashless economies. And we have some economies that have almost reached cashlessness, and others that use cash widely. When you take this point of view about money plays a role to make up for privacy of histories, when you pursue models like that, you'll often kind of see that that currency, in that sense, is a quite primitive form of summarizing histories. And we would be a lot better from lots of points of view if we were able to use histories. And technologically, well, I don't know, we use them a lot these days. So I got a bit interested in cryptocurrencies from the following point of view. It seemed to me that if I come along and issue a bunch of yellow pieces of paper, and I ask you to give me something valuable for my yellow piece of paper, you're going to be worried about many things. Two things you're going to be worried about is, well, you know, am I going to kind of issue a whole bunch tomorrow and next year and thereafter, which is going to make your yellow piece, if you take it from me, kind of worthless. And you're going to be worried about whether it could be counterfeited by others who are duplicating my yellow pieces of paper, leading to the same kind of depreciation. So my casual reading about cryptocurrencies made me think that this invention had solved these two problems. Now, we've heard a lot of details about, well, maybe not exactly, but, you know, let's abstract from those difficulties and say that they've solved those two problems. And the papers we heard yesterday, I think in the morning and maybe later on in the day, they also abstracted from these difficulties and they sort of said, okay, you know, let's treat these things in that way as if we have a fixed stock of them and counterfeiting is not a problem. So if we take that point of view, it sort of says that, so let's take that point of view and return to the idea that we want to think about payment instruments in terms of the informational network that supports them. Now, when I compare, you know, paper currency and a cryptocurrency from the point of view of an informational network, if I, you know, buy something with two $20 bills, you know, the budget constraint or the feasibility of that transaction is sort of guaranteed if you're not worried about counterfeiting. I have the stuff and I'm handing it to you. Now, the informational network, as I understand it, for these cryptocurrencies is doing nothing but duplicating that feature. It's harder because it's electronic, but that's what it's doing. Now, the fact that we can, you know, make transactions online, maybe among strangers, is certainly a huge deal. I met my current wife on OkCupid. So, I mean, I think it's just hugely important. I mean, we both live in State College, which is a tiny town in the middle of Pennsylvania, where Penn State is. But although we were separated, I would say, I don't know if you counted 1 degree of separation or 2. I had a colleague who knew her and knew me, but I guarantee we would never have met. So anyway, it's a huge deal. And so cryptocurrencies, you know, allow people to meet lots of other people, I think that's a big deal. But they're using what is a very, kind of primitive form of transacting. And credit instruments of various sorts are in some sense much advanced. And so from that point of view, if not from others, I wonder about how big they're going to be in terms of the actual economy. We heard papers yesterday about multiple equilibria, and certainly I issue bunch of pieces of yellow paper, and you issue blue pieces, and so on and so forth. There's a huge multiplicity. I've written about that in other contexts in the past. So that's a problem, and none of the papers we've heard that have delved into the mechanics and limitations of cryptocurrencies, none of them have gone in the direction of saying, no, this multiplicity is not something to worry about or be concerned about. And I think it's just there.
Yeah. I'm an economist that practices and invents markets, and sometimes they get it wrong, and lots of times they get it wrong, and sometimes they get it right. So I think that if one were to hypothesize applications and uses following Neil's remarks, there's some pretty evident things going on. Ethereum particularly, with smart contracts and private blockchains, one would think is going to be ubiquitous. This coming week, as a matter of fact, ICE, the Intercontinental Exchange, which owns the New York Stock Exchange and derivatives exchanges around, is going to introduce a payment system, and the key partner is Starbucks. So one could imagine how far this might go, and I think Neil has justly identified all of the questions around ownership and transactions costs, and one can imagine transactions, certainly with land ownership, title companies, what's the role, custodial, between the blockchain and cryptocurrencies. These could and might be totally disruptive and have big economic impact. Should there be a title insurance business? One wonders.
Right. Let me piggyback on that a little. As Lars mentioned, Rob Townsend, who is not here, gave a wonderful talk last evening at dinner. And one of the things he said, I think, was hugely insightful. He talked about ledgers, and he made the remark that most of our economic models just assume that there's a ledger. So, we don't talk about, or we don't pay a huge amount of attention in our models that I buy a house from you, and we don't, pay a lot of attention to the huge headache it is to make that transaction. So now you're going to make it less of a headache, so that's great. But most of our economic models have said that aside from explicit assumptions about imperfect monitoring, private information, the ledger is not a big deal. And so, maybe these developments are going to make, that more applicable. But it's true. Some years ago, I used to occasionally introduce a graduate course in monetary economics by handing out a table of the GDP by origin, by industry. And that's the last data they see in my course. But then I asked the question, if you look at this industry breakdown of GDP, how much of it fits within the Arrow-DeBreur model? And this whole sector, which is called fire, finance, insurance, real estate, it's not in there. And it's a big chunk of the economy. I mean, back in the financial crisis, how much of it was, in Iceland? It was almost the whole economy. But, it's sort of not in the Arrow-DeBreur model. And so that was the introduction to a course in monetary economics, which we said, we got to focus on some of these things if we're going to understand money. But yeah, it's important.
A compliment or piggybacking on that, Ronald Coase, who was a friend and a mentor, urged me over time to recount what it's like to start a market, because many economists assume that there is a market. And in my experience, that's a problem that to create one is a 10 or 20 year thing. So that assuming there's a market prevents economists from looking at
Right.
the web that has to begin, that whether it's regulatory costs, legislative costs, costs of building the institution, cost of designing a specific contract that transfers ownerships, those problems are all assumed away in the same way Neil is mentioning. We assume away a lot of these, but those institutional elements are very important, and perhaps the profession should pay closer attention to that.
So it's been very interesting being a moderator for this panel. I circulated questions in advance. As far as I can tell, a lot of the questions I was going to ask have now been answered, so we can actually skip through many of them. It's the dangers of advanced circulation. Anyway, I would like to follow up on a couple of things, though. One is, so Neil brought this up. There's a variety of alternative cryptocurrencies, and do we see this as going forward as a situation in which, yes, the models have multiple equilibria and the like? We're going to look for one that's a big survivor, just because the whole network's going to function more efficiently with one currency, or are there enough distinct rules that this is a case where multiple currencies can survive and thrive?
I'll take a first stab at it. I would forecast, and that's always a dangerous thing to do, and I'm told to do it cautiously, but I think that the number of currencies will expand dramatically. There were, if you look at the Motley Fool and Google it, you'll see they wrote, it'll be the lead article if you Google it, that there were 1,600 in something, and I'm not like Neil, I don't have the data in front of me, but just roughly speaking, in March there were 1,600, and then when this article was published a month later, there were 1,658. There's now 2,000 that have come up from one, and aside from Bitcoin, because one could imagine cryptocurrencies for loads of commodities. As a matter of fact, one could imagine that what was not possible when he wrote a paper about the currency backed by commodities in 43, one could never imagine a basket of commodities acquired by the central bank to back a currency. With Bitcoin, one can imagine, you know, a gold commodity, an oil commodity, every sort of thing, and goods and services like medical services and legal services. This whole technology, and there's already multiple uses of these in the private cryptocurrencies, not the public ledger, but private ledgers. And I would think that these can be used applications within. So I have an exchange that I've had to work for, is the American Financial Exchange. And we have a private currency within it. And what we do is every time, and these are loans, so every time a loan is created, there's a coin. The loan allows, and I had a discussion with the vice chairman of the Fed recently about it, because the loan is we can identify the buyer and seller, okay, the borrower and lender. That's pretty important. We can identify the credit status of the borrower, very important. We can identify what region the loan originated in and what region the loan was bought. So we can essentially track, and we can talk about non-performing loans, et cetera. What do we have in that? And we've got a field of 25 entries that the Fed was very interested in tracking, because is the Southeast growing and the Northeast not growing? Are there monetary flows that are not? And last, just to make it quick, is a huge amount, and we have a collateralized loans, which is like a repo. And we can track the actual collateral. The Fed, you know, has 900 billion a day of repo transactions, and we don't know the underlying collateral. What a rich field for empirical study about are these securities in scarcity? Do they have higher repo rates? We have a whole range of things, and the Federal Reserve uses reverse repos as part of its monetary policy, and no idea the collateral underlying those transactions. So there's reasons to believe that we could find these currencies ubiquitous.
Mm-hmm. Shall I comment
Sure.
on that?
Yeah, please.
Well, I think we want to distinguish between what might be called backed currencies and unbacked currencies, or outside money and inside money. And sure, there are going to be loads of inside monies. I think
Yes.
your examples are those kinds of things. Outside monies, yellow pieces of paper, blue pieces of paper, purple pieces. I mean, I'm kind of doubtful. You know, one of the things that one might think about in thinking about cryptocurrencies, and this comes up a lot in lots of areas. There's a whole field of economics involved with networks. The idea that certain kinds of commodities are more useful to one person, the more widespread their uses is among others. And presumably something like that applies to these cryptocurrencies, right? And so, I don't know, that's a pretty well-developed field. I mean, it applies to platforms and all sorts of things. It seems really important.
I think the distinction you made is critical, and I would share your belief. The inside, as you refer to it, is cryptocurrencies can just explode. As far as the outside, it's a question of 2 or 3 maybe that already exist. And I would share the view that that's a very different story and very much more difficult to forecast.
So I want to end with just one more question. This has to do with governments and central banks and the like. So let's just take the case of Sweden, the Swedish central bank. Sweden cash has been, the use of cash has diminished substantially, as it has through many other economies. This has led the Swedish central bank to be very to explore ideas of digital krona, because they're kind of aware that their existing currency is its demand for it is going to dry up. It makes me think again about Friedman's demand for money functions, I guess. But so what makes them wonder, to think there's an important role that they should play in terms of making availability electronic versions of currency in order to replace their current paper currency. What role do you see central banks playing in terms of issuing things like e-currency, and how does this change how we think about monetary policy and the conduct and the like?
So I'm not familiar with details, but from what little I've heard about the Federal Reserve creating an e-currency, it's in many respects not going to be so unfamiliar. I mean, it's going to replace $20 bills by effectively accounts at the Federal Reserve System. Mm-hmm. So, fine. And it may pay interest on them. Okay. Mm-hmm. That calls for all sorts of issues about coordination between monetary and fiscal policy.
Yeah.
But I mean, those sort of issues are already there. Mm-hmm. So I don't know. From the point of view of monetary theory, I wouldn't think it's all that big a deal.
Just to answer it, to amend it, it might, because of transactional things, have effects, of course, on a $20 bill and those sorts of things. But it also might make Hayek's stuff make it that may have been prohibitively transactionally now feasible, and if it does that, it's indirect, and I think what's happening, it may happen, is I think the Fed is going to be able to learn from what is going on, or any other central bank, based on what happens in the private sector. And I'm reminded of the fact that in the 19th century here in Chicago, the Chicago Board of Trade invented grain standards, based on, protein content, infestation, water, etc. And the federal government ultimately adopted those, and those are now the USDA standards. So to what extent is the public sector based on private sector activities, and it is going on in Sweden as ping pong or something that's going on, and currency or data repositories. I think part of what's happening in Sweden is so much of the economy has gone cashless, and there have been lots of pockets of inventive activity which is informing the central bank on what it might do. So I think we have to keep that in mind. it won't be necessarily monetary policy, but it will be just the change in which those infrastructures operate.
I think at this juncture, I'd like to open it up to the audience for some questions. There's a mic back here. This question here.
Just to follow up on the previous question, you mentioned e-currency. We all have digital bank accounts at banks, and we pass digital money to each other. What difference, if there is any, do you see between the current system and the system where we make another system of digital money and call it a coin or whatever we call it?
Yeah, I'm not sure there's a big difference. I would make one remark that is not directly about your question, but Bitcoin was created at a time when nominal interest rates were about 0. Would have had the same impact in a world when, say, nominal interest rates were 10%. And people tell me that there are cryptocurrencies which pay interest. There's a huge distinction. Now, an interest is not going to be in the form of the same thing. It's going to be in the form of another valuable object like Federal Reserve notes or something, right? Because if there's one uncontroversial proposition in monetary theory, it's that if you just hand out money proportional to holdings, that doesn't do anything. And so paying dividends in the form of the same stuff is like a stock split and doesn't do anything. But anyway, if you try to think about a cryptocurrency which pays interest or dividends in the form of other stuff, well, can it be this kind of decentralized thing that's one of the big virtues? I'm not sure. I mean, it sounds like somebody's got to have the obligation to make these interest payments. And it seems to maybe call for a different kind of governance.
I would differ slightly on that. I think smart contracts, Ethereum, they can be collateralized, they can be private blockchains. I do think that it will be big, not in a sense, I would agree with Neil in the sense of the macro point of view, but if you take a look at bank revenues now today, and we worry about bank revenues because that ultimately impacts the net capital that they have, earning streams, et cetera. In a recent survey, the New York Fed said 33 to 40% of the big banks' revenues are from payments. If we change the profitability of a commercial bank by taking away 40% of their revenues, I think you have to worry about the policy implications of that. I mean, these disruptions are quite potentially large because they impact the capital in the banking system. And if you take away Northern Trust or State Street Bank's custodial function, so it's not only banks that are very active in lending, but trust banks.
Yeah.
You're going to change a lot in the system. And as I say, big banks, 33 to 40%. So I would agree in general it isn't, but it's going to be winners and losers.
Absolutely.
And that's the point that I would make. The amount of wins and losses and who does or doesn't, has a big impact. And so in that context, the blockchain now, there's a major company that advertised in the FT that there are supposedly going to be 20,000 regulations a year affecting banks. And the compliance costs of that, again, I take a University of Chicago viewpoint that transactions costs of any sort are going to have a big impact on economic institutions and at the macro level.
But then maybe that's all fine, because the only reason why we care about banks is because of their role in the payment systems. If we don't need banks for payment, then
Right.
they're just private businesses like the others. We don't need to regulate them, and we don't need to worry about it.
That's the point. There's going to be an enormous amount of disruption, and economists may want to be thinking about the path. It goes back to what Neil was saying and I was saying earlier about assumptions. We can prove anything as an economic assumption. If I'm allowed to make the assumption, I can prove, or one can prove, almost anything you want. and it's really about premises. And I would think in the economics profession, one should be thinking about these disruptions and the path to them. So it's like assuming there's a market. If in fact that happens, that's all good. But it should be of interest in how that happens, so something radically doesn't go wrong in the process, which sometimes happens in the government sector.
Harold?
So I want to ask a question about both of you, about thinking about technological developments in the future and the incentives for that, and comparing private sector money versus government money, right? So one perspective is that government can provide medium of exchange more cheaply. We have seen papers that are very skeptical that you could have, the current systems doing efficiently what the government does. But we have learned, from many examples in past history that once you give to the government, I don't know, the French image telephones or the railway system or something, that eventually, when you privatize these things, this unleashes innovations, and that eventually you get a better product emerging from the private sector than from the public sector. You mentioned green and yellow paper, right? So maybe what's really happening is that the private sector eventually will develop a yellow paper that's better than the green paper that the government produces, because it can write stuff on it. You mentioned all the contingencies and so forth, and there seem to be private sector's incentives to think about developing these kinds of papers that maybe the government doesn't have. So, I guess, Neil, you're very skeptical that we're seeing this happen, and you're thinking the crypto is going to disappear. I think Richard is more optimistic in thinking at least some portion, will survive. But going forward 20 years, are private currencies taking over, possibly because of that? Or is it just going to be a fad that's going to be, dying out? Are you willing to venture prediction on that?
Not so easily, but let me make some related remarks about everything we've been talking about. I don't know, here's the United States. We've gone through huge disruptions in the past 20 years, right? We had a financial crisis, which was a huge disruption. Many people view the development of China and its exports as a huge disruption. So, maybe we haven't lived through these disruptions, but they've been around. When we talk about banking and some of these developments, people mention, how nice it is to be able to go around the banking system and make it maybe a transfer of funds across countries. We've heard about this. In my view, there are all sorts of aspects of the U.S. economy in which the public is getting ripped off by companies. I mean, I think it's a scandal what we pay for internet services and things like that. I mean, where I live in State College, I mean, we have essentially one provider of linking to the internet. And we've heard papers about these companies starting up. What did you call them? ICOs, and one view of those things is those are attempts to sort of get around the rigmarole of other ways of financing activities, which for some strange reasons are hugely expensive in our economy.
I'll make one last comment. Yeah, I do lean towards this thing, and it's really because these inventive activity in the financial sector, I believe as a practitioner, has an enormous value. When we take a look and I quip, Dodd-Frank has got 2,300 pages. It's bigger than the New Testament, Old Testament, and Quran combined. The CFTC has a definition of a swap. It's 899 pages. If one of my students and all of you in this course would take more than a paragraph to describe a swap, I would suggest economics and finance might not be their optimum career choice. What I worry about is, and I would hope that you, the best and brightest, will worry about it. I worry about the rents that are created by stagnation. Okay, and the bills that are implemented that provide an incredible amount of rent creation and legislation that may be designed to create rents as much as solve a problem.
Absolutely.
And so if you disrupt, it's kind of like our vision of term limits. The disruption is in the financial sector is somewhat like a term limit might be, because once that legislation gets in place, then the regulators get it, and there's an unholy bond that's built up between regulators and lobbyists, and half the legislation that I've seen in my narrow career is often written by the people who is intended to be regulated. That's a peculiar situation and provides incentives that are different. So I don't have a problem with it, and I think good regulation is, I made my career in it, and I think, though, we have to be careful of the rent seeking that comes out of it, and disruption in the financial sector changes that.
So I think with that, we're going to close this session, and please, we will have a coffee break, and you can discuss this informally, but I want to thank both of you for some very thoughtful comments.